This example lays out for the class operational leverage and financial leverage. Within financial leverage, we show capitalization and weighted average cost of capital at different mixes of debt and equity, and also under a recapitalization. First, let's set up the situation. Assume you have just been hired as a business manager for Pizza Palace. The company's EBIT was $50 million last year and it's not growing. The firm is currently financed with all equity, in other words, no debt, and has 10 million shares outstanding. When you took your finance class, your instructor stated most firm owners would be financially better if there was some debt. And you suggest this to the boss. He encouraged you to pursue the idea. As a first step, you obtain from the firm's investment banker the following estimated cost of debt for the firm at different capital structures. So, without any debt, of course, the cost of debt would be zero. When you have 20% debt and 80% equity, the cost of debt would be 8% a year. That would increase at 30%, so you have more risk and your cost of debt would go up. Same at 40%, it would increase to 10%, and at 50% debt, so at 50-50 debt and equity, it would cost 12%. Next, there are a couple of questions which you can look at on your own. I'm going to move down to look at operational leverage. Here it says, show the operating break-even point if a company has fixed costs of $200, a share sales price of $15, and variable cost of $10. That's shown here. If you sell zero, the revenues is obviously zero. Your fixed costs are still $200. Your variable costs are zero, so total costs are $200. If you sell 80 units, your revenues are 80 times 15, the price per unit. And the fixed costs are still $200. Total costs are the $200 fixed costs plus the 80 units times the variable cost of $10 per unit, or 1,000 units. This table or this chart lays this out. So no matter how many you sell, 0 or 80, your fixed costs are the same, $200. Your total costs increase, so they're at a minimum $200 with the starting at the fixed costs, and then they increase variably from there up to $1,000 at 80 units sold. Revenues also increase from 0 to 1,200, going from 0 units sold to 80. So you can see this is the break-even point at which you start achieving profitability, revenues minus total costs. But this little equation shows you how to calculate the break-even point. Break-even in terms of quantity is fixed costs divided by the price per unit minus the variable cost per unit. So if the fixed cost is $200, you divide that by price minus variable cost. So 15 minus 10 is 5. 200 divided by 5 is 40 units. And that's where this break-even point is. So anything above that 40 units sold is profit. Anything below is loss. Okay, so we just looked at operational leverage. Now we're going to look at financial leverage. We say, now to develop an example which can be presented to the management to illustrate the effects of financial lever, consider two hypothetical firms, firm U, unlevered, and there's no debt financing, and levered, which uses $10,000 of 12% debt. Both firms have $20,000 in assets, a 40% tax rate, and expected EBIT of $3,000. So let's look at these two hypothetical firms. Capital in both is $20,000. Tax rate is the same. Equity in the unlevered, because it uses no debt, is 20, and the levered is 10. In the levered, we also take on 10 of debt at a rate of 12%. So we'll construct partial income statements. It starts with EBIT for the two firms. EBIT for both is $3,000. The interest, there's no interest for the unlevered. For the levered, right, let's look at that. It's the $10,000 times 12% each year. So when we subtract it out, earnings before tax is $3,000 for unlevered, $1,800 for levered. We take 40% of that, right? 40% of the 3,000 is 1,200, and subtract to get net income. And we do the same here for the levered. 40% of 1,800, 720. And when we subtract, the net incomes for the unlevered is $1,800, and for the levered is $1,080. In both cases, the ROIC is 9%, right? So it's 3,000 times 1 minus B7, the tax rate, divided by B73, the capital. So in both cases, we're dividing by the same capital, $20,000. Now the capital is composed differently under unlevered and levered. $20,000 for the unlevered of equity, $10,000 equity for the levered, and $10,000 of debt for levered. So we're going to see how return on equity differs for the two. For unlevered, the net income is $1,800 divided by 20 for equity. For the levered, even though the net income is lower, $1080 instead of $1,800, the equity put in is only $10,000, half as much. And so our return on equity is higher for the levered. So those shareholders who put up the $10,000 instead of $20,000 are getting a lot higher return for the amount they put in. So in other words, the $10,000 that these shareholders are putting up for the levered firm are getting much more net income back per dollar. This just shows net income for unlevered is $1,800. For the levered firm, there's $1,080 for net income and also interest of $1,200 going to the debt. So what we saw under good times, when EBIT's 3,000, it's better to take on the debt for the equity holders because they're going to get a higher return on equity. But now let's look what happens in a bad time. We're going to skip some of these questions, but during a bad time, and EBITDA falls to just 2,000. So it was 3,000, and now we're going to have maybe the sales aren't as high or the economy's not as good, and the EBIT, earnings before interest and taxes, declines. Well, still our interest on debt for the levered firm is still $1,200. That didn't change. Earnings before tax is now $2,000 for unlevered, $800 for the levered. Taxes are still 40% of the $2,000 here, or 40% of the $800 there. And net income is $1,200 for unlevered and $480 for levered. So return on invested capital is the same. We still have 2,000, or not still, but now we have 2,000. 1 minus the tax rate divided by capital, right? So, ROIC is the same in both instances, but our levered firm, even though it did better before under the good times, when EBIT declines to 2,000, it's doing worse, 4.8. Why is that? Well, we have 1,200 of net income divided by 20,000 of equity. Here we have, keep doing that. We have 480 of net income divided by 10,000 of equity. So the fact that EBIT declined, even though we're putting up less equity, it's not making up for the fact that net income is a lot smaller here, 480 versus 120. So when the times are bad, the levered firm really gets hit because our return on equity is lower now than the unlevered. Okay, now with those points in mind we just covered, consider the optimal capital structure. For each capital structure under consideration, calculate levered beta, the cost of equity, and weighted average cost of capital. So here we're assuming beta is 1 for this firm. If we went out to get the risk-free rate, it'd be 6%, and the market risk premium 6%. So for capital asset pricing model, to value the equity, it's 12%. 12 is 6% for the risk-free rate plus 1 beta times the risk market risk premium is 1 times 6 is 6%. So 6 plus 6 is 12. We're assuming here now that expected free cash flow is 30. There's no growth in the free cash flow. Tax rate is 40%, and shares outstanding is 10. We'll come back to the price here in a minute. This is a formula we'll use where the value of operations equals free cash flow times 1 plus the growth rate divided by weighted average cost of capital minus G. So since G is 0 in these cases, these zero out, and it's just free cash flow divided by weighted average cost of capital, right? So the value of operations here is D129 free cash flow times 1 plus D130, 0. So that'd be 30 times 1 is 30, divided by weighted average cost of capital is 12, minus growth. So in essence, this formula is, since the G's zero things out, is 30 divided by 12, right? 250. So that's the value of operations. We're assuming we have no short-term investments, and no debt. So the value of the equity is 250. If we had 10 shares outstanding, the price per share would be 250 divided by 10 is $25 per share. The investment bankers provided estimates of the cost of debt. Other rows are explained below. So here's the weights of debt. So here we had 0% in debt, 20, 30, 40, 50. Here it's the opposite. So 100 declining to 50 is the amount, the weight of stock. And here we were given above the cost for debt. So 0 to 12. That was given at the very top. 0 to 12. So we know what the beta is when there's no debt, 1. The cost of equity is 12, given above. The weighted average cost of capital is 12 because it's 12 times 100%. That's our 57 times B155. 57 is 12% times 100, right? So basically this is taking the weighted average cost of capital of the equity portion and the debt. The debt is accounting for the tax deductibility of debt, although in this case, so the weight of debt is 0, so that whole side's 0. Value of operations, we calculated, right, is the 30 D129 divided by the 12% weighted average cost of capital. There's no debt, the value of the stock, and there'd be 10 shares, so the price per share is 25.